Global inflation is cooling, but that trend is colliding with severe geopolitical instability. Protecting wealth means navigating a market where stability is an illusion. This chart of India's Consumer Price Index shows headline inflation at a multi-year low of 2.8%. Because that red line is sitting well below the RBI's 4% target, the central bank has the room it needs to shift its strategy. We can see that shift in action across these four liquidity tools. The RBI has deployed a massive 125 basis point cut to the repo rate, effectively pushing capital back into the system to counter slowing growth. However, this correlation between Brent crude and the rupee reveals a major vulnerability. A $10 surge in oil, driven by Middle East conflict, could widen India's fiscal deficit by 42 basis points and put immediate upward pressure on bond yields. 2026 is a high disruption environment. Relying on traditional assumptions of safety in this climate will actively erode your purchasing power. The default playbook for an Indian investor has historically been simple: park the bulk of your cash in bank fixed deposits for safety and rely on small-cap equities for aggressive growth. But as the RBI continues its rate-cutting cycle, those fixed deposits are transitioning from a safe haven into a liability. Falling interest rates mean your gross yields are locked into a downward trajectory. Simultaneously, the small-cap growth engine is stalling. Corporate earnings are slowing, and the constant threat of foreign institutional investors selling off their holdings makes these stocks highly volatile. This matrix tracks the trajectory of a traditional 60-40 portfolio. You can see the drift happening in real time. The portfolio is moving out of the low-risk, high-return quadrant and sliding toward a position of higher risk and lower real yield. To protect wealth in 2026, you have to abandon the old playbook. The math now demands a strategic reweighting into duration debt and precious metals to secure actual post-tax returns. For high net worth individuals, the primary problem with bank deposits isn't just the yield, it's the punishing 30% tax burden applied to the interest. When you take a dropping growth FD yield and subtract that 30% tax, your real return against inflation effectively hits zero. You are taking on lock-in risk for no actual growth. The structural alternative is to shift that defensive cash into actively managed duration debt or arbitrage fund of funds. These duration funds turn the RBI's rate cuts into an advantage. As bond yields compress, these funds capture capital gains, allowing your principal to grow as interest rates fall. The ultimate advantage is mathematical. While the fixed deposit yield is sliced down by a 30% tax, these debt structures allow you to secure a much more favorable 12.5% long-term capital gains tax rate. To get this benefit, you have to accept a specific trade-off. Your capital must be locked up for at least 24 months, and you must tolerate minor short-term fluctuations in your principal. In a falling rate environment, wealth protection is about prioritizing post-tax carry rather than chasing a guaranteed gross yield that disappears on tax day. This performance data shows why gold and silver have become the most talked about assets of the year. Gold delivered a 63% return in 2025, while silver surged 125% in the same period. The question for investors is whether this is a temporary geopolitical spike or a mathematically grounded supercycle. The answer lies in the supply and demand data. This chart of gold discoveries shows a severe supply shock. For the first time, there were 0 major discoveries in back-to-back years. Since moving from discovery to production takes a decade, the 1995 peak is a different era. The supply pipeline remains structurally dry. On the demand side, this forecast shows ETF investors returning as buyers after a 3-year absence. They are joining central banks, which have been aggressively accumulating physical gold as they attempt to de-dollarize their reserves. But holding metals requires discipline. You must accept extreme price volatility, 0 intrinsic cash flow, and use strict stop losses to protect capital. Precious metals are no longer just an optional hedge. They are a mathematically constrained asset class that now demands a permanent structural allocation in your portfolio. Transitioning back to equities requires a hard look at corporate earnings. With growth slowing globally and foreign investors turning into net sellers, the momentum that drove the market over the last several years is hitting a structural wall. This is why the institutional stance for 2026 is strictly neutral. You should prepare for moderate returns and high volatility throughout the year. This environment demands a defensive shift. Capital is moving out of high-flying small caps and into robust large caps, private banks with strong credit cultures, and the healthcare sector. The market is also vulnerable to the FPI wildcard. If the US dollar remains strong, it can trigger sudden, damaging sell-offs by foreign investors in emerging markets like India. By playing it safe in large caps, you are making a conscious trade-off. You are intentionally capping your upside if the broader market experiences an unexpected rally. Equity investing in 2026 is strictly about capital preservation and limiting drawdowns during geopolitical spikes, rather than chasing multi-bagger returns. Generic financial advice fails in a volatile market. The right portfolio for 2026 depends entirely on your specific tax bracket and your psychological tolerance for risk. We map your strategy using this decision tree, routing you to an optimal allocation based on your financial goals. If in the 30% tax bracket, your priority is capturing tax-efficient carry. This path terminates in a debt-heavy arbitrage fund of funds. The second profile is the tactical allocator. You are looking for aggressive growth and structural hedges against inflation, even with assets at historic highs. This profile points to a multi-asset structure. As this pie chart shows, this fund takes an aggressive stance, with a 20% weighting in gold and 7% in silver to capture the metal supercycle. Finally, the conservative retiree. Your goal is simple. Avoid the psychological stress of massive commodity price swings while maintaining steady growth. This path routes you to balanced advantage or equity savings funds. These rely heavily on debt for stability and carry zero exposure to volatile metals. Achieving a perfect alignment between your personal tax reality and the macro environment is the only way to protect wealth in this cycle. The ultimate trade-off for 2026 is clear. You must sacrifice the familiar comfort of bank deposits and high-risk equities to capture strategic post-tax yields and structural hedges. Do not let hype dictate your positions. Cap your precious metal exposure strictly according to your mathematical risk appetite. 2026 will reward calculated precision over blind optimism. Identify your exact investor profile and execute your defense playbook immediately.